Hi, I'm Jimmy. This video is the start of a new series on stock options. So in this video, we're going to look at a few different ways we can use options, one of them to generate cash flow for our investment portfolio, a lot like dividends. Then in future videos within this series, I'm going to touch on a bunch of different options strategies that gradually get more interesting and more dynamic. So hopefully we can use options to generate income for our portfolio, or maybe protect our portfolio on the downside. The amount of ways we can use options, the list goes on and on. Okay, so let's kick it off. So we have two investors. Our first investor's name is Jimmy. He wears a t-shirt that says, "Hi, I'm Jimmy," because for some reason, he feels the need to introduce himself every time we see him. Clearly, he's got issues he's working through. And our second investor, well, clearly she's quite confident. Just look at the way she's standing. Her name is Emily, and she does not feel the need to say, "Hi, I'm Emily," every time we see her. Okay, enough about them. So as one piece of her portfolio, Emily owns shares of Verizon. In fact, she owns 100 shares of Verizon, and this is important because generally speaking, one option represents 100 shares of stock. She bought her 100 shares back in June, where she paid an average price of $57.03. Now, a few months have passed, and she's up a bit in the stock since the current stock price is about $60 per share. Now, she's been able to collect some dividends over that time as well, so her total return is a bit better than it looks at first glance. But now she's looking to generate more cash flow so she can put that money to work in some other potential positions she's been considering. She's considered selling her Verizon shares, but doesn't mind holding it for now. Now, Jimmy, on the other hand, well, he really likes Verizon stock, but he doesn't have all the money he needs to buy the 100 shares that he wants to buy. And he thinks that Verizon stock is going to go up, or he's afraid it's going to go up over the coming months before he gets together enough money to buy the shares he wants. So clearly, what do? They get involved in options. So Emily decides that she's going to sell one call option, and Jimmy decides that he's going to buy one call option. Now, just so we're all on the same page, these two investors never actually meet. They never actually find out about each other. Each of them place their trades with their own brokerage firm, and then everything gets done from there behind the scenes. So you'll never actually know who's on the other side of the trade. I'm just running these two stories side by side so we could see the way they're both thinking. Okay, so Emily's selling the call option and Jimmy's buying the call option. So what is Jimmy buying and how much does he pay? Well, Jimmy is buying the option to buy Emily's 100 shares of Verizon stock. So Jimmy goes ahead and he pulls down an options chain, which is basically a bunch of quotes for options. This is what that looks like. Now, I pulled this down on January 8th, and we could see that this group of options expire on March 20th. That's 72 days away from the day I pulled down the quote. So this tells us that if he buys one of these options, by the way, each one of these lines represent a different option. Well, if he buys one of them, he must decide what he's going to do with the shares or with the option no later than on the close of business on March 20th, because that's when these particular options expire. Okay, simple enough. So whatever Jimmy's going to do, he has to do it by the 20th, by the expiration date. So we know that he's going to have the option to buy Verizon stock by that date. But what price is he going to pay for it? Well, that's what the strike price is. He gets to choose any one of those strike prices, whichever one he wants to buy, and he then has the option to buy 100 shares at that strike price. Now, you might ask, how do we know that this is for 100 shares? And almost all options trade in blocks of 100 shares. They almost always represent 100 shares. So they're not going to indicate it anywhere. We just have to know one option represents 100 shares of stock. So if he wants the option to buy 100 shares of Verizon stock at $60 per share, well, he would have to pay $1.42 per share today. That would give him the option to buy those shares at $60. If he's willing to pay $62.50, well, he would have to pay just $49, which is the same as 49 cents per share. Because it's important to note that we should notice that these quotes are generally in a per share basis, even though they are talking about one options contract. We know that an option represents 100 shares, so 49 cents turns into $49 as the total cost for the option. But there's one issue. Jimmy isn't sure if he's going to have the $6,250 needed to buy all 100 shares by March 20th. So he says, all right, what if I switch to a longer term option? So he switches over to April 17th, which is 100 days away. Now, if we're wondering where these dates come from for the different options, well, it's actually the third Friday of any month is when monthly options expire. There are some shorter term ones, but broadly speaking, monthly options expire on the third Friday of the month. Now, we may notice that the price of these options went up. The strike price remains the same. Don't forget, the strike price is how much we would pay for the underlying stock, but the option price went from costing Jimmy $49 last month to $60 in this month. And that makes sense if we think about it, because Jimmy bought another month. That extra $11 is called the time value. The more time you want, the more it's going to cost you. So let's imagine that this is the option he decides to go with. He pays $60, and right now he owns the option to buy 100 shares of Verizon stock at $62.50. And he knows he has to do it on or before April 17th of 2020. Okay, so he places the order with his brokerage firm. Luckily, he doesn't pay any commissions. Well, they automatically deduct the $60 that the option is costing him right out of his brokerage account right now. Okay, Jimmy's done. Now, let's flip the story back to Emily, who's still trying to decide what she's going to do. So Emily is also, coincidentally, focusing on the April 27th options as well. And don't forget, she already owns the 100 shares of Verizon stock. So what is Emily thinking? Well, Verizon stock currently pays a quarterly dividend of about 62 cents per quarter. This is decent, but Emily's looking to generate more cash flow out of this position. So what she's going to do is she's going to sell somebody else, in this case, Jimmy. She's going to sell somebody the option to buy her shares, and they will essentially pay her to do that. Now, conveniently for our story, she chooses the same option that Jimmy chose. Expiration date of April 17th, strike price of $62.50. So she knows that if somebody exercises this option on her, they elect to take the shares from her, they have to pay her $62.50 per share. She doesn't mind that because she bought the stock down near 57, so she's willing to sell it for a profit. So she goes online to her broker, she places the sell one call option order, and she gets the same price as Jimmy. Pretend she got a price of 60 cents per share or $60. Generally, if we're going to sell an option, that's the column that's usually the price you would get. But for the case of the story, let's pretend she got $60 as well. Okay, so now what happens to Emily? Well, much like what happened to Jimmy, the $60 trade that she just placed, in this case, gets deposited directly into her account. So she gets that $60 right away, much like a dividend payment. Well, now the option is out there, and what they end up doing is they both end up sitting and waiting. But don't forget, she does not have the option here. The option goes to the buyer of the option. She sold the option. She's not in control as to whether or not they exercise this option on her. And luckily, she already owns the 100 shares of Verizon stock needed to fill the option if it ever is exercised. If she only owned 99 shares or 50 shares or 0 shares, well, it would be considered an uncovered call option or a naked call option. Those are a bit trickier. We'll get into those in another video. So for now, she owns 100 shares. Now let's fast forward to expiration day to see what Emily and Jimmy are doing. Well, there's two scenarios. Scenario one, Jimmy was wrong. Verizon stock doesn't move higher like he thought it would. It moves a little bit higher, but not much. Instead, it moves to $61 per share. And this is on the day of expiration. Scenario two, well, Jimmy was somewhat right, and Verizon stock is trading at $65 per share. Now, we can't forget that both of these people that got involved in this option, well, the option at the stock at the time, Verizon stock, was trading at about $60 per share. So scenario one is the easiest. The option says that Jimmy can buy the shares of Verizon stock if he wants to for $62.50. That was a strike price. But with the stock currently trading at $61, well, there's no shot Jimmy's going to pay $62.50 when he could just buy the 100 shares on the open market for $61. So what happens? Well, at the end of that trading day, at the end of expiration day, the option expires worthless and Jimmy is out the $60 that he paid for that option. The fact that the stock went from $60 per share, which is where it was trading, up to $61 or $62 is irrelevant. It didn't get above the $62.50, so the option expires worthless. Now, scenario one works out quite well for Emily, because don't forget, she bought her shares of Verizon stock back in June, where she paid about $57.03. Now the stock is trading at about $61. So she's up about $4 per share or $400 total dollars. Plus, she already got the $60 premium that she received when she sold the call option. So she's up $460, and this serves the exact purpose she was hoping for. She got to generate some extra income with this position on top of the dividends she would have collected in the meantime. Now, the beautiful part to this for her is that perhaps she can do this again. The stock is now at $61 per share. Maybe she goes out, sells another option for 3 months away from the current price again, but instead of doing $62.50, maybe she decides to do a $65 option. This could, in theory, help her generate a decent amount of income until the stock gets called away from her. Okay, how about scenario 2? Well, in scenario 2, Jimmy gets to decide what he wants to do. At this point, Verizon stock is trading at about $65 per share. And the options at that time would most likely be trading for about $2.50 per share, since the current stock price, 65, is $2.50 above where Jimmy is allowed to buy it, which is $62.50. So we can assume that would be trading right around that point. Now, that means that if Jimmy wants to buy the shares, he needs the $6,250 to cover those shares, which covers the entry price of those. He already paid the original $60 from the option premium early on. He doesn't have to do that now. Right now, it's just a matter of putting up the cash to buy the actual shares. Now, let's pretend he doesn't have the money. Pretend he couldn't come up with the money to buy the shares. Well, another choice for him is to simply sell the option. He owns it. He bought it. That's listed in his account. Right now, he could just place an order to sell that. Like we said, it's probably worth about $250. So he paid $60 to get into the option. He sold it for $250. Not bad. Over the 3-month time period, not a bad profit. So maybe that's what he decides to do. Now, on Emily's side, we might be asking, what is she doing in this whole scenario? Well, in scenario 2, with the stock being in the money, they call it in the money when the current price is above the strike price. With the stock being in the money, she's going to lose her shares. That's going to happen. Now, we might be asking, well, maybe what if Jimmy decides to sell the call option and he doesn't actually exercise the option? Either way, her shares are going to be gone. Even if that happened, the brokerage firm would jump in and take the shares, and they could buy the shares from her for $62.50 and sell them right away for $65. So we just have to assume her shares are gone no matter what. Unless, of course, she chooses a different option, and her other choice, besides letting her options get exercised, another choice for her would be to simply buy back the option that she originally sold. So she sold it to start the trade. Now, maybe she buys it back. What would happen there? Well, again, we're assuming that option is worth $250. She would have to buy it for $250, and it's going to expire at the end of the day. So essentially, she sold something for $60, bought it for $250. She would take a $190 loss. But if she wants to keep her shares, that might be worth it to her, since the stock is up more than $2.50 per share, or $250 from where she had the exercise price. So if she had decided at any point that she wanted to keep the shares, well, she could simply do the reverse of the original trade. She originally sold, now she would buy back to close out the position. So those are the two primary choices on both sides of the trade. Do you sell the option, or do you buy the option? Do you get out of your current position is probably a better way to put it, or do you exercise the option? Now, we have to remember that Jimmy has the option to exercise. He could have exercised today on expiration day, could have done it a week ago, a month ago. So as the seller of the option, Emily has to be aware that those shares could get taken away from her at any time. What she does know is that it has to happen before the expiration date, and she knows what price she's going to get. Maybe she doesn't mind that. She bought the stock at $57, and now it's at, if it got exercised, she'd get $62.50 for. Not too bad, plus whatever she gets when she sells the option. So as we can imagine, call options can be used in many different ways. Now, the other side of the option coin is the put option, which gives the buyer of the put option the right to sell shares of a stock at a certain price by a certain date. We'll dive into that topic next, but if you're interested in learning more about put options right now, well, this could be a good next primer video for you to watch. There's a link here and there's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. I know this was a longer video. Thanks, and I'll see you in the next video.